The impact of slowing foreign institutional investment, FII, and foreign direct investment, FDI, on an economy. Foreign institutional investment, FII, and foreign direct investment, FDI, play a crucial role in the economic development of a country. However, when these investments start to slow down, it can have a significant impact on the overall health of an economy. In this narrative, we will explore the consequences of such a slowdown and understand its implications for the country. At the heart of global financial markets lies the concept of FII. It refers to the investment made by foreign individuals, organizations, or institutional investors, such as mutual funds or pension funds, in the securities of a different country. These investments typically involve buying stocks, bonds, or other financial instruments of a foreign country's companies and governments. On the other hand, FDI conceptually differs from FII as it involves a foreign investor establishing a long-term presence in a host country. FDI can take the form of setting up a subsidiary or acquiring a controlling interest in local companies. When FII and FDI start to slow down, it indicates a decline in the flow of foreign funds into the country. This decline can have several implications for the economy, affecting various sectors and stakeholders. Firstly, a decrease in FII and FDI could have a detrimental impact on the country's stock market. Foreign institutional investors are significant participants in the stock market, and their reduced involvement can lead to decreased liquidity and reduced demand for stocks. This can cause stock prices to decline, adversely affecting local investors and the overall market sentiment. The slowdown in FDI can also have adverse effects on the economy. Foreign companies that invest in a country through FDI often bring along new technologies, management expertise, and job opportunities. When FDI decreases, the economy may experience a shortage of these resources, and local firms may struggle to fill the void. A decline in FII and FDI can also have repercussions on the currency exchange rate. When foreign investors invest in a country, they typically need to convert their currency into the local currency. This increases demand for the local currency, leading to an appreciation of the exchange rate. Conversely, a reduction in foreign investments can cause a decrease in demand for the local currency, leading to a depreciation of the exchange rate. This depreciation can have inflationary consequences, as the prices of imported goods and services become more expensive. Beyond the financial sector, the slowing of foreign investments can also impact other sectors of the economy, such as manufacturing and services. FDI often brings new technology, machinery, and knowledge transfer to the country, which can boost productivity and competitiveness in these sectors. A decrease in FDI can hinder the country's ability to upgrade its industries and increase their efficiency. Moreover, FII and FDI can contribute significantly to job creation. When foreign investors invest in the country, they often generate employment opportunities. Whether it is through setting up new businesses or expanding existing ones, foreign investments can provide jobs to the local population. Consequently, a slowdown in FII and FDI can lead to a decline in job creation, exacerbating the unemployment situation in the country. Furthermore, FII and FDI have a positive impact on the country's balance of payments. FII often represents short-term capital flows, while FDI represents a more stable and long-term commitment. These investments can increase the inflow of foreign currency.
One of the best decisions I made all year was to invest in tools that improve my productivity. I make a lot of videos, and so I needed something that could help speed up the editing process. And this is when I found the cloud-based video creation platform Kapling, which has helped my team and I make videos 10 times faster.
A decline in foreign investments can also affect the overall investor sentiment towards the country. When FII and FDI slow down, it can signal a lack of confidence in the country's economic prospects. This loss of confidence can further deter potential investors and make it challenging for the country to attract foreign funds in the future. In conclusion, the impact of slowing FII and FDI on an economy can be far-reaching. It can affect the stock market, currency exchange rate, job creation, industrial development, balance of payments, and investor sentiment. Therefore, it is crucial for governments and policymakers to closely monitor these trends and implement appropriate measures to encourage foreign investments and safeguard the health of the economy. When the flow of foreign institutional investments, FII, and foreign direct investments, FDI, slows down in a country, it can have a significant impact on its economy. This reduction in foreign investments can lead to a decline in capital inflows, which can affect the overall economic growth and development of the country. It can also result in reduced job creation, as FDI often leads to the establishment of new businesses and industries. Additionally, the decrease in FII and FDI can cause currency depreciation and increase the country's dependence on domestic savings, which may have limited resources. Ultimately, the slowing of FII and FDI can hinder economic progress and stability. Foreign institutional investment, FII, and foreign direct investment, FDI, are two significant terms that represent different avenues through which foreign funds flow into a country's economy. While both involve foreign investment, they differ in terms of the purpose, nature, and level of involvement. FII, also known as portfolio investment, refers to the investment made by foreign institutional investors such as mutual funds, hedge funds, and pension funds in the financial markets of another country. These investors are primarily interested in short-term gains and tend to buy and sell securities like stocks and bonds. Their investment decisions are driven by factors such as economic conditions, market trends, and expected returns on investment. FDI, on the other hand, refers to the investment made by foreign entities in a country's real assets, such as factories, infrastructure, and businesses. Unlike FII, FDI involves a long-term commitment and often requires a direct ownership stake in the company or asset being invested in. Foreign companies may establish subsidiaries, joint ventures, or wholly owned operations in the host country to expand their business activities and access new markets. The key difference between FII and FDI lies in the level of control and influence exercised by the foreign investor. With FII, the investor has minimal control over the management and operations of the company in which they have invested. They are essentially passive investors who rely on the performance of their investment in the financial markets. In contrast, FDI allows the foreign investor to have a higher degree of control and influence over the invested entity. They may actively participate in decision-making, transfer technology, and bring in managerial expertise. Another crucial difference is the impact of FII and FDI on the economy. FII is generally seen as more volatile compared to FDI. Since FII involves short-term investments in financial markets, it can lead to rapid capital flows that can be beneficial in stimulating economic growth. However, it also makes the economy susceptible to sudden outflows if the investor sentiment changes. In contrast, FDI provides a more stable and long-term source of investment. It creates job opportunities, improves productivity, and contributes to technology transfer and knowledge spillovers, which can have a positive impact on a country's economic development. From a policy perspective, FII and FDI are often treated differently by governments. FII flows are typically more fluid and subject to regulations aimed at safeguarding financial stability. Governments may impose restrictions on FII investments to prevent excessive speculation or protect domestic industries from abrupt market fluctuations. FDI, on the other hand, is generally encouraged and seen as a driver of economic growth. Governments often provide incentives and favorable policies to attract FDI, such as tax breaks, infrastructure development, and relaxed regulations. In summary, FII and FDI are different forms of foreign investment that vary in terms of purpose, nature, and impact on the economy. FII involves short-term investments in financial markets and provides minimal control to investors, while FDI involves long-term investments in real assets and allows for a higher degree of control and influence. FII is more volatile, while FDI is stable and contributes to economic development. Governments often regulate FII to ensure financial stability, while they actively encourage FDI to spur economic growth. In order to understand the economic prowess and potential of two Asian giants, India and China, it is imperative to analyze their foreign institutional investment, FII, and foreign direct investment, FDI, scenarios. Both FII and FDI play crucial roles in fostering economic growth and development by injecting capital and contributing to the overall productivity of a nation. To start with, FII refers to the investments made by foreign individuals or institutions in the stock markets of a country. It involves the purchase of stocks, bonds, or other financial instruments. On the other hand, FDI entails the direct investment in a country's physical assets such as factories, buildings, and machinery. In essence, FDI represents a long-term commitment by foreign entities to establish or expand their presence in another country's economy. When comparing the FII and FDI landscapes of India and China, it is clear that both countries have witnessed significant inflows of foreign investments over the years. However, China has often enjoyed a larger share of FDI compared to India due to various factors such as its size, market potential, and government policies. China has continually attracted high levels of FDI due to its open economy, competitive manufacturing sector, and vast consumer market. Multinational corporations have been enticed by its infrastructure development, availability of skilled labor, and efficient supply chains. China's journey towards becoming the factory of the world has made it an attractive investment destination, with FDI fueling its rapid economic growth. India, on the other hand, has traditionally seen a higher influx of FII compared to FDI. The Indian stock market has been a preferred destination for foreign investors due to its robust financial system, transparency, and potential for high returns. The growth of sectors such as information technology, pharmaceuticals, and services has further stimulated FII inflows into India. However, FDI in India has been growing steadily in recent years, driven by a range of policy reforms and initiatives aimed at attracting foreign investors. One key distinction between India and China in terms of FDI is the sectoral composition. China has seen significant FDI in manufacturing, particularly in industries such as electronics, automotive, and textiles. In contrast, India has witnessed greater FDI inflows in sectors such as services, pharmaceuticals, and renewable energy. India's focus on expanding its services sector, including information technology, business process outsourcing, and financial services, has been a major catalyst in attracting foreign investors. In terms of FII, both India and China have experienced substantial inflows, but with different driving factors. China's FII has been influenced by factors such as its market performance, government policies, and economic indicators. On the other hand, Indian FII has often been driven by factors such as global market sentiment, interest rate differentials, and the performance of Indian companies listed on stock exchanges. While China has historically enjoyed higher FDI inflows, it is worth noting that India has made significant strides in recent years. India has implemented several policy reforms to improve the ease of doing business, simplify regulations, and attract foreign investments. Initiatives like Make in India, aimed at boosting manufacturing, and changes in foreign investment caps in sectors like defense and insurance have helped attract greater FDI to India. Furthermore, India's demographic dividend and rising middle class make it an appealing market for foreign investors. The country's young and educated population provides a robust consumer base, propelling demand in various sectors. As a result, India has been actively working on reforms and initiatives to enhance its investment climate and attract more FDI. In conclusion, when comparing the FII and FDI landscapes of India and China, it is evident that both countries have witnessed considerable inflows, albeit with different focal points. While China has traditionally attracted more FDI due to its manufacturing prowess and market potential, India has excelled in attracting FII through its financial markets and service sector. However, with ongoing policy reforms and a proactive approach to attracting foreign investments, India is working towards bridging the FDI gap with China. Both countries continue to evolve their investment environments to attract foreign investors and sustain their economic growth trajectories.